Hello, I'm George Cattat, financial strategist with Four Oaks Financial. Welcome to Market Moments with George. Please like and subscribe to get weekly notifications. The markets are a mess. It's a chaotic jumble of signals, flashing red and green. 1 minute, you're riding high on a wave of optimism. The next, you're staring into the abyss of uncertainty. This past week was a prime example. We saw it all: warning signs, market tumbles, and even a few surprising surges. It's enough to make even the most seasoned investor feel a bit queasy. The job market for new college graduates is often seen as a leading indicator. It's a canary in the coal mine for the overall economy, and right now, that canary isn't looking too healthy. Recent graduates are facing a much tougher job market than their predecessors. Gone are the days of multiple job offers and signing bonuses. The reasons for this shift are complex. The economy is cooling down after a period of rapid growth. Companies are tightening their belts and becoming more cautious about hiring. And some industries, particularly in the tech sector, are experiencing a slowdown after years of booming growth. For recent graduates, this shift can be disheartening. They're entering a job market that's far more competitive than they expected. Many are being forced to lower their expectations, accepting jobs that might not be their ideal fit. Some are even moving back in with their parents, putting their lives on hold as they navigate an uncertain economic landscape. It's a tough reality check after years of optimism and promises of a bright future. This slowdown in hiring isn't just bad news for graduates, it's a warning sign for the broader economy. If companies are hesitant to hire new graduates, it suggests a lack of confidence in future growth. It means they're anticipating a slowdown in demand and are adjusting their hiring practices accordingly. And that's something that should give everyone, not just recent grads, pause for thought. The tech sector, once an unstoppable force in the market, has hit a bit of a rough patch. Software stocks in particular have taken a beating, and investors, once enamored with the promise of growth and innovation, are starting to ask tough questions. They're looking at valuations and wondering if the hype has outpaced reality. Several high-profile tech companies recently reported disappointing earnings. Meta, the parent company of Facebook, saw its stock price plummet after reporting a decline in users for the first time in its history. Netflix, the streaming giant, also faced a backlash from investors after reporting slower than expected subscriber growth. These setbacks have sent shockwaves through the industry, raising doubts about the sustainability of the tech sector's dominance. So, is this the end of the tech boom? Are we witnessing the bursting of a bubble that's been inflating for years? It's too early to say for sure. The tech sector is known for its volatility. It's a sector prone to booms and busts. What goes up must eventually come down. However, it's important to remember that the tech sector is also incredibly resilient. It's a sector driven by innovation, and there's no shortage of that. New technologies and trends are constantly emerging, creating new opportunities for growth. While the current downturn might be painful for some investors, it's unlikely to spell the end of the tech sector's dominance. Amidst the turmoil in the tech sector and concerns about the broader economy, there was at least one bright spot this past week: the Dow Jones Industrial Average. The Dow, often seen as a barometer for the health of the US economy, posted a significant gain. It was a welcome reprieve from the recent volatility and a sign that maybe, just maybe, things aren't as bad as they seem. The Dow's performance was driven by a number of factors. Energy stocks, which make up a significant portion of the index, rallied as oil prices rose. Banks also performed well, benefiting from rising interest rates, and some blue chip companies, seen as safe havens in times of uncertainty, attracted investors looking for stability. However, it's important to note that the Dow's performance doesn't necessarily mean that everything is rosy in the economy. The Dow is a narrow index comprised of only 30 large cap stocks. It doesn't tell the whole story of the market, let alone the entire economy. The Dow's performance this past week should be seen as a positive sign, but it's not a guarantee of future gains. The market is still facing a number of headwinds, including rising inflation, supply chain disruptions, and geopolitical uncertainty. Investors should remain cautious and stay diversified. This past week in the markets was a mixed bag. The college job market showed signs of weakness, raising concerns about the broader economy. Tech stocks took a hit after a series of disappointing earnings reports. However, the Dow Jones Industrial Average managed to post a significant gain, offering a glimmer of hope. The market remains volatile, and investors should proceed with caution. Take control of your financial future. Contact me today.